In this video, we're going to continue and complete the cash flow from investing activities. We have already done the cash flow from operating activities, which is the most challenging part of the cash flow statement. And we followed all of these rules for the cash flow from operating activities. So please make sure you pay attention to that, because that's where a lot of people have difficulties. Okay, so now we're going to do the cash flow from investing activities. So what's the rule for cash flow from investing activities? Well, it says, did long-term assets increase due to spending cash? In other words, did you buy long-term assets with cash? If you did, then you're going to minus. Did long-term assets decrease due to receiving cash? In other words, did you sell long-term assets and get cash? If you did, then you're going to add. And that's it. It's really, really simple. And if you come down to the summary here with long-term assets, you're going to have the list of long-term assets. And then if you sold any of these items for cash, you add. If you bought long-term assets or bought any of these items with cash, you subtract. That's it. Because spending cash means you decreased cash, and so it's going to show up as a minus on the cash flow statement. Selling something and receiving cash means cash increase, so it's going to show up as a positive on the cash flow statement. And so what you're going to get here, when I assign you a problem, I'm going to give you a balance sheet and I'm going to give you other information. You're going to use this other information to complete the investing and financing activity section. So in the investing activities, remember, investing activities, we're only looking for long-term assets. And what are the long-term assets? You can just look at the handout, and these are the long-term assets: land, building, furniture, equipment, patents, copyright, trademarks, and goodwill. If it's not a long-term asset, we're not going to do anything with it in investing activities. So we have 5 items here: land, furniture, stock, and dividends. Well, stock is not a long-term asset. If you look over here, stock is in the equity section. Dividends are not a long-term asset. Dividends are in the equity section. And then more stock, again, that's in the equity section. We're only interested in things in the long-term asset section. So what are the 2 long-term assets? Land and furniture. And what's the rule? Well, you sold long-term assets for cash, you add. You bought long-term assets with cash, you subtract. So here we have land was sold for $24,000 in cash, right? So cash receipt for the sale of land, what are we going to do? We're going to add. It's positive. We received cash. And then furniture was purchased for $35,000 in cash. So cash payment for the acquisition of furniture, and that's minus $35,000. And that's it. Those are the only 2 items that are cash flow from investing activities, because these are the only 2 items that are long-term assets. These other 3 are going to go in financing activities because they are equity items. All right, and so net cash provided by investing activities is going to be the sum of these 3, and these 2. And when I add these together, I get net cash provided by or used by investing activities of $11,000 negative. And oftentimes, cash flow from investing activities is negative because what companies do is when they get extra cash, a lot of times they spend that cash to grow the company, which oftentimes means buying more land or buying a building or buying more equipment. So the spending of cash to accumulate long-term assets is not a bad thing. So cash flow from investing activities being negative is not a bad thing for the company. That's a sign that the company is investing in itself and growing the company. All right? So that's how you do cash flow from investing activities.